Well, good afternoon, everyone. Let's go ahead and get started. I'm Reena Agarwal, the Vice Provost for Faculty at Georgetown University and Director of the Georgetown Center for Financial Markets and Policy. I want to welcome you to our Georgetown Global Virtual FinTech Seminar Series. The center has been hosting this seminar series since the very beginning, when the coronavirus pandemic started. We started the seminar series, and it's really been fantastic to have finance scholars and others join us every Friday. We started with several top-notch, very well-known senior faculty in the area who presented their research and sometimes talked about broader issues related to fintech and what academia should be doing. And it's been terrific. But I must say, we're also really committed to making sure that we provide an opportunity to a wide and diverse group of faculty to present their work and get feedback, because for some faculty, it's been a little bit difficult to get feedback during this environment when they can't travel for conferences or to give papers and seminars at different universities. Okay. So today's event on Crypto Day is brought to you by the Center in conjunction with the Ripple University Blockchain Research Initiative. And we are delighted to bring together scholars who are going to present their work on cryptocurrency. And I just want to point out that the previous events are on our website and they have been recorded. Please visit our website and follow our Twitter hashtag @GUFinPolicy. And I want you to know the reason we've been able to do these seminar series is a huge thank you to Alberto Rossi. Alberto is our Associate Director at the Center, and also to Anna Kormis. Anna is the Assistant Director of the Center, and they have pulled this together very nicely and very quickly. So again, thank you for joining us. Do feel free to use the hand and the chat feature to ask your questions. We'll wait until the end of the presentation. And with that, I'm going to hand this over to Professor Rossi, who will moderate the Q&A. But our first speaker is Amin Shams. And so, Amin, it's all yours.
Thank you very much. Let me share my screen first. Is it working? Okay, perfect.
Perfect.
All right. Thank you very much for the opportunity to present my paper. I'm going to talk about the structure of cryptocurrency returns today. So basically, the blockchain technology has shortened the gap between developing ideas and creating investable instruments based on those ideas. And because of this, we have seen a huge number of cryptocurrencies coming into existence in a very short period of time. Like today, we have more than 4,000 cryptocurrencies, if not more, trading in the market. And these cryptocurrencies have a very active market. We have more than 200 cryptocurrency exchanges that work on a 24/7 basis. And also, some of these exchanges have actually very active volume, trading volume. And because of this active market, I mean, a lot of people invest in this market. Some of them became Bitcoin millionaires. Some of them lost their entire investment overnight. And because of this active market and because of unique features of cryptocurrencies, like a huge amount of speculation in the market, a growing literature by financial economists have been devoted to understanding prices in this market. And my paper contributes to this literature, basically. But so far, our understanding of prices in this market is quite limited. We don't know what drives cryptocurrency prices, or at least we have a limited knowledge of what drives cryptocurrency prices, what determines the structure of return in this market, what is the source of the underlying value, how do investors actually think about the underlying value. So my paper basically contributes to this literature by documenting a very strong and persistent return structure for cryptocurrencies and analyzing a host of characteristics, crypto characteristics, that might be driving this return structure, and hopefully shed some light on these questions. So let me start with a couple of facts here. First of all, if you look at the pairwise correlation of cryptocurrencies, like if you pick top 100 cryptocurrencies, look at their pairwise correlations over the past couple of years. This graph shows the pairwise correlations from beginning of 2017 to a couple of months ago. There is a huge variation in these correlations. Some cryptocurrencies correlate hugely. It's like they have correlation of 0.8, 0.7. Some cryptocurrencies even show negative correlations during this period. And this correlation is very persistent over time. So it's not just random. If you sort cryptocurrencies based on their lagged correlations, you see that they show a very strong correlation. Those cryptocurrencies that had a high correlation in the previous month or over the previous 6 months, they show also a high correlation over the next month or over the next 6 months. And the result holds whether you use like daily returns, weekly returns, different horizons. There seems to be a strong return structure here. And the main question of this paper is, what actually drives this return structure? The fact that these cryptocurrencies here, these cryptocurrency pairs show a high correlation, is it because they have the same technology, they have the same consensus mechanism, they are like active in the same token industry, they basically have the same age or size, or there are other factors that can explain this return structure? And another fact that I use to basically create one of my characteristics for cryptocurrencies and examine their return structure is that, as I said, we have so many cryptocurrency exchanges and trading platforms. We have more than 200 of them. And there is a wide variation in the market share of different cryptocurrencies on different exchanges. For example, if we look at Ripple here, XRP Ripple, this column, we see that a huge percentage of Ripple during the period of this graph actually traded on the BitHump exchange and also Coinwine, which are two South Korean exchanges basically that are also open to South Korean investors. But we don't see, like Bitcoin, for example, only 2% of Bitcoin traded on these two exchanges. But more than 30% of Ripple, almost 30% of Ripple traded on these two exchanges. So there is a wide variation in the market share of different cryptocurrencies on different exchanges. And I'm going to talk about this, that different exchanges, because of different geographical restrictions, because of different governance rules, they actually attract different kinds of investors. For example, BitHump is only open to South Korean exchanges. Coinbase is very popular among US investors. Zaif is very popular among Japanese investors because it only accepts Japanese yen if you want to wire transfer your money to the exchange, basically. So because of this, we have different investor clients on different exchanges, and also different cryptocurrencies have different exposure to these different investor clientele. So that's the basis of one measure, one critical measure that I define in the paper, and I see if it can explain this strong return structure that I document here. So just to briefly overview the results, I find that cryptocurrencies who have similar size in terms of market cap, similar trading volume, similar age, similar consensus mechanism like proof of work, proof of stake, and also tokens with the same industry show significantly higher co-movement. But the highest variation is actually explained by a connectivity measure that I construct to proxy for similarity in cryptocurrencies investor bases using the trading location that I just showed you. Okay. I find that cryptocurrencies with a 1 standard deviation higher lagged connectivity actually show 0.22 standard deviation higher correlation in the next month returns. And the effect increases in time horizon and lead to a cross predictability. Basically, just to give you an example, if you compare Ripple and Bitcoin, if Ripple generates 1% higher weekly return than Bitcoin, in that week, those cryptocurrencies that are more connected to repo, they actually generate 75 basis points higher return than those cryptocurrencies that are more connected to Bitcoin. Okay, and this is contemporaneous, but also this return premium continues over the next couple of days and the next week. Okay. The next I do is that I basically explore potential channels for explaining this connectivity measure. So it could be that cryptocurrencies with similar characteristics, they're basically clustering on certain exchanges. And what I'm capturing with this measure is unobservable characteristics of these cryptocurrencies. So I look at plausibly exogenous changes in the location of these cryptocurrencies, and I see that that actually explains variation in their co-movement with the same magnitude. So it doesn't seem to be an observable characteristic. What it seemed to be is I look at the order flows of crypto investors on different exchanges, and I see that there is a strong exchange-specific component that drives cryptocurrencies' order flows. In fact, because cryptocurrencies are listed on multiple exchanges, at the same time, for the same cryptocurrency, I can see the order flows on multiple different exchanges. So I see that, in fact, the order flows of a given cryptocurrency on a given exchange is more related to other cryptocurrencies on that exchange than the same cryptocurrency on other exchanges. Okay, so it seems that there is an exchange-specific component in order flows that's also driving cryptocurrency return structure. And the third channel that I investigate is that the underlying value of cryptocurrencies is attributed to the network effect. So there's a large literature on that, theoretical literature on that. Because of this network effect, because demand for holding a cryptocurrency can come from users and developers that can affect the underlying value of cryptocurrencies. When you see a demand growing for a cryptocurrency, that can signal adoption. Okay, so I find that these common demands, these correlated demands at exchange levels, they actually translate into 36 to 51% additional co-movement for cryptocurrencies that heavily rely on the network effect. And I'm going to explain how I measure this network effect, and I'm going to explain the setting. But this is very interesting. That's basically the way people believe about different cryptocurrencies and their attribute, their value to this network effect. That actually has very strong pricing implication. And that suggests that maybe a starting point for understanding cryptocurrencies returns, if you look at the investor demand, user demand, and potentially try to disentangle these different types of demands and understand their underlying value. So basically, when we talk about cryptocurrencies value, if we can have an analogy with stocks, we can assume that cryptocurrencies have a dividend. Many of them don't have, but if you assume that they have a cash flow, they have a dividend, that dividend is endogenous to this demand for holding them by users and developers. All right, so my paper relates to a very large and growing literature on cryptocurrencies. I'm not going to go through all of them. These are just some examples, but mainly it relates to an empirical asset pricing literature on cryptocurrencies. Liu and Savinsky have 2 papers there. Hu, Parlor, and Rajan have a paper there. It also relates to the network effect. Kang-Li, Wang, Sakin, and Zhang, we have papers here, theoretical papers that I basically provide some empirical evidence here. And also the fact that I find cryptocurrencies with similar consensus mechanism show a higher co-movement, that relates to papers by Fahad Saleh and Koz John. All right. So I'm going to skip data, or I'm going to talk very briefly about the data. I have 3 types of data. One is trade and pricing data. I have exchange level, hourly pricing level from a huge set of exchanges. Actually, this is an old number. It should say 150 exchanges because I updated the data. This is from Coin API. I have a data from Kaiko that has a limited set of exchanges, and also the timeline is more limited, but I have the entire order book. So I can look at the order flows of the same currency on different exchanges. And I also use CoinMarketCap data to just cross-check the validity of these prices in these exchanges. It requires a lot of cleaning. The data is a bit messy, but having 3 different sources actually helps to clean the data and cross-check that. I have data on technological features of these cryptocurrencies from so many different sources, like their cryptographic algorithm, consensus mechanism, token industry, and different characteristics. I also have data on social media web pages of these cryptocurrencies. So these cryptocurrencies have different subreddit pages. Each cryptocurrency has its own dedicated page. Bitcoin has its own. Ethereum has its own. And I look at the comments on different pages to basically quantify the extent of importance of network effect for different crypto communities. So these tables shows the number of currencies in my sample and the number of exchanges and the average listing per currency, like how many exchanges is a typical currency listed on cryptocurrency. So I apply basically liquidity filters and market cap filters. I only include cryptocurrencies above $1 million market cap, and also those who have a daily transaction number of more than 1,000 transactions, like based on lagged values, to avoid having illiquid cryptocurrencies here. My sample starts with 23 cryptocurrencies in the beginning of 2017, and then it goes all the way to 2020, March 2020, with 485 cryptocurrencies. So my hope is that I'm capturing larger and more liquid cryptocurrencies. The results also hold if I even look at a more limited set of cryptocurrencies, a limited set of large cryptocurrencies. So basically near the end of the sample, after all these filterings, I end up with 135 cryptocurrency exchanges. And on average, if each cryptocurrency is listed on around 10 exchanges. These exchanges are registered on so many different countries around the world. We have a lot of them in the US, in China, and in many cases, these different geographical locations, it's accompanied with some restrictions. As I mentioned, Bithumb is only open to South Korean exchanges, Zape is popular among Japanese exchanges, and so on. And there are other differences between these exchanges. They have different identity verification requirements. They have different limitations on deposit, withdrawals, different transaction fees that can attract different types of investors, both in terms of like nationalities, in terms of large investors, small investors, those that are like institutional investors, or those that want to keep their identity secret. They basically make cluster on different exchanges. There are frictions between these exchanges, and also, as I said, there's a variation in share of cryptocurrencies on different exchanges. Using this setting, I basically define a connectivity measure between any given pair of cryptocurrencies. So this is a pairwise measure. You have it between Bitcoin and Ripple, Bitcoin and Ethereum, and any other pairs of cryptocurrencies, which basically measures the distance between 2 given cryptocurrencies in this space of exchanges. If you assume that, like, if you have 70 exchanges at a given time, you can assume a 70-dimensional space. Position of each cryptocurrency is the percentage volume of that cryptocurrency on those exchanges. And then this measure captures the distance between those, or proximity between those cryptocurrencies. If 2 cryptocurrencies trade on entirely different set of exchanges, one of them on Bithumb, the South Korean exchange completely, and the other one on Coinbase in the US, they basically have 0 connectivity. But if they heavily trade on the same set of exchanges, their connectivity is pretty close to 1. So that's the intuition behind the measure. And this measure creates an interesting cross-sectional variation between different cryptocurrencies. So if you look at the network of cryptocurrencies based on this connectivity measure, each node here shows a cryptocurrency, and the edges between different nodes shows their connection through the connectivity measure. And different colors shows different clusters that have very close proximity based on that measure. We see that, for example, Ethereum Classic and Ethereum, they basically share the same history of blockchain. They are the forks of the same blockchain. Technologically, very similar, but we see that Ethereum Classic in terms of trading is more similar to Litecoin here, not Ethereum Classic. On the other hand, like Bitcoin Cash, which is a fork of Bitcoin, that's actually closer to Ethereum than Bitcoin. Or Ripple has its own island because it mainly trades on a separate set of exchanges. It's basically connected to these purple currencies that we see here. So it's not that like cryptocurrencies with the same technological features or characteristics cluster on the same set of exchanges, but we see a variation that's beyond other similar characteristics captured by this measure. And if you look at within the clusters, like if you zoom into this brown cluster of cryptocurrencies and this green cluster, we see that there is also a huge variation within clusters. So it's not that all these cryptocurrencies have the same connectivity to other cryptocurrencies. So this creates a huge cross-sectional variation that we can basically examine if this connectivity measure can explain co-movement of cryptocurrencies and also along with a host of other cryptocurrencies. So basically, I use a pairwise setting here, similar to Anton and Polk 2014. It's a JF paper that basically this setting, because we don't know much about the structure of the factor structure of cryptocurrency returns, it allows us to directly compare different characteristics of cryptocurrencies and their co-movement. So I want to see if correlation of any given pair of cryptocurrencies at time t can be explained by a host of characteristics at time t-1, similarity in characteristics, and also this connectivity measure. So the baseline results basically says that those cryptocurrencies that are connected, that have one, so by the way, everything here is standardized except for dummy variables, so we can compare the coefficients. Those who have one standard deviation higher similarity in connectivity, they show almost 24 basis point higher connectivity, 0.24 standard deviation higher connectivity in the next month return correlation. Size also have a strong effect, trading volume, number of trades, age of these cryptocurrencies, also whether they're coins or tokens. Coins basically have their own blockchain. They're more like currencies, and tokens basically provide specific services, and they're built on top of other blockchains usually. So we see that there are a host of characteristics that can explain correlations, this return co-movement, but connectivity by far explains the most in terms of the magnitude of the coefficient, the amount of within fixed effects R squared, time fixed effect R squared, basically the cross section of variations that can explain. It explains almost 6%. All the other characteristics combined, they actually explain less than this connectivity measure. And in the paper, I provide some other measures to capture the economic magnitude. And similarly, if I look at coin pairs and token pairs separately, because they also have different technological features, I see that again, the connectivity holds as strongly, but also I see that proof type of these cryptocurrencies have a strong effect. So basically, those cryptocurrencies with similar proof type, consensus mechanism, whether they are proof of work, proof of stake, they actually show 0.11 higher standard deviation co-movement. And if I look at token pairs, those in the same industry actually show a higher co-movement. So these results are pretty robust to different specifications, whether I use a Fama-McBeth regression, whether I use Bitcoin denominated prices versus US dollar denominated prices, whether I use within exchange prices. So one issue here could be that I'm using prices from different exchanges, and there could be some mechanical issues here. But I do the same analysis within exchanges, within BitHum, within all the cryptocurrencies that are denominated in Korean won. I look at those that are more connected through being connected on other exchanges. So you have two cryptocurrencies on BitHum that are connected because they are also connected on Binance, for example. I look at cryptocurrencies within BitHum within those cryptocurrencies that are denominated in the same price on the same exchange, I see almost the exact setting. So if I look at different deciles of connectivity, let's look at here. This is the within exchange results, for example. If I look at different deciles of connectivity, those that are more connected within the same exchange, they show by far higher return correlations here. And so basically, I look at different settings. I see that, again, if Ripple, for example, generates 1% higher return.
I mean, just to interrupt, 4 minutes, 4 or 5 minutes until the end of the presentation.
25 minutes?
Yeah. Okay. Yes, I think, yes, now it's 12:27, so until 12:31, 32. Go ahead.
Okay, great. All right. So I look at different settings, the magnitude, I compare the magnitude, and then I examine 3 different channels. So I'm gonna skip the first 2 channels. Actually, basically, I look at plausibly exogenous changes in trading location due to shutdown of Chinese exchanges by the Chinese government. And I see that the correlation changes to the same degree, almost comparable to the baseline results. And I look at commonalities in the order flow. Basically, I find that there's this, I can decompose the order flows into exchange-specific, currency-specific, and a market-wide component. And I see that this exchange-specific is basically by far the main driver of order flows. And the last set of results that I look at is this network effect, basically. So the idea is that because users and developers also have demand for these cryptocurrencies, and because the value of cryptocurrencies depend on this demand by users and investors, cryptocurrencies, these demand shocks may translate into a higher price impact for cryptocurrencies because it can affect their basically underlying value. So, and my empirical strategy is that we have different cryptocurrencies. The importance of the network effect is different for different cryptocurrencies, and I'm going to explain why. So I try to capture this importance by looking at their communication of crypto community on different online forums. So basically, each cryptocurrency has a subreddit, dedicated subreddit. Bitcoin has its own page, Ripple has its own page, and I look at the comments on these pages. Let's look at a couple of examples, and then I tell you how I measure the extent of network effect. So it turns out that people in crypto community, they actually talk a lot about concepts like network effect, Metcalfe law in very relatively sophisticated language. Like this one says you should look at community support and number of developers working on projects for a certain platform. There is no other project with network effect even close to Ethereum. This one says how many users can Coinbase onboard every day. The more people that own one Litecoin, the faster the value grows. So Coinbase is a cryptocurrency exchange. It basically says the more people go on Coinbase and buy Litecoin, the higher the value of Litecoin. And this one says Bitcoin is growing at its fastest pace in history in terms of network user adoption. Bull run is not over until Bitcoin is past gold 10 trillion. This is during the boom of 2017. So we talk about all these price swings in cryptocurrency and why they're prone to price swings. One channel explaining it could be potentially that because these demand shocks could be interpreted as a sign of adoption, price actually reacts a lot to these demand shocks. So I use 25 million currency-specific comments from Reddit. I read and label 10,000 of them as whether they are talking about the network effect or not. I use that, create a machine learning model to label the rest of 25 million comments, and I quantify the percentage of comments for each cryptocurrency each month that talks about these issues. So this is the feature importance of the random forest model here. We can skip this. The measure actually creates a wide cross section, and it's very persistent over time. Like 1 month lag autocorrelation coefficient of the measure is 0.6. And the average measure for Ethereum is, for example, almost 7%. Almost 7% of the comments talk about these issues, but only 2.5% talk about Ripple. Talk about these issues on Ripple community. And I mean, this is why a total number of comments is almost the same for Bitcoin and for Ethereum and Ripple. And if you look at the exact words like network effect, user adoption, community building, people talk 6 to 17 times more about these concepts on Ethereum community than Ripple community. And this is not a normative statement. These are just, they are having different natures in basically different kind of functionalities. And this shows major coins with high network effect. We see that platform tokens that offer decentralized applications or smart contracts, they usually rate high. But anyway, so what I see is that if I look at basically the interaction of this connectivity measure and the network effect, I see that it strongly explains cross-sectional variation in co-movement. So for example, this graph is, I think, the last results that I want to share here with you. So if you look at different quantities of connectivity, and if you look at if you compare the correlation between high network cryptocurrencies, those cryptocurrencies that show a high quantity in the network measure, and compare the correlation with low network cryptocurrencies, they actually don't have a different correlation when they are not connected, connected to the same community. But if you look at those cryptocurrencies that are highly connected, they're exposed to the same investor bases and the same community, they actually show much higher co-movements, basically when you look at the cross-section. So the idea is that, just to sum up, I show this persistent return structure for cryptocurrencies, and I look at a host of different variables that can explain this. This connectivity measure that proxies for similarity in investor bases of cryptocurrencies seem to explain the most variation. And it's partly because it captures the exchange-specific commonality in demand of crypto investors that's amplified through this network effect channel. Okay, so that's basically the finding of my paper. Sorry for going over time a little bit.
That was fantastic. I mean, thank you so much. So let's do this. I'm gonna ask, Will Song has one question. I'm gonna ask him to unmute himself. Will, yeah, you may speak. Go ahead.
Thank you very much. A very interesting paper. Just a very quick question. We talk about the network effect, which is the third channel. That's very important. I'm just wondering, is there a size effect as well? And do they interact? Right? Maybe we'll see some non-monotone effect there. That's the question I have. A quick remark is the volume data that we have from these data sources are, I think, reported transaction volumes. And in fact, there's a large fraction of faked transaction volume reported. So it'd be nice to control for that. I'm happy to share data on estimated wash trading or fake volume with you later. Thank you.
Thank you, Will. Yeah, that's great. So your first question, I actually see a strong size effect as well. Cryptocurrencies of the same size, they actually show significantly higher co-movement, and I showed them in this table. Your second question, I was actually very concerned with this, that there are a lot of fake volume here. So this is the size effect, basically. Cryptocurrencies that have one standard deviation, more similar size, they actually show 0.09 standard deviation higher co-movement. Regarding the volume, so what I do in the paper is that I create another measure that only look at the extensive margin. So only looks whether a cryptocurrency is listed on an exchange or not. It's 0.1. I totally ignore the magnitude of the volume. And the effect is actually stronger a little bit, which can suggest, like, when I use the volume measure, it has a lot of noises due to the fake volume. So thanks for the comment. I'll reach out to you after the presentation for the fake volume. Thank you.
Perfect. Thank you so much. I mean, so I think the best way to proceed may be the following. So why don't we go to the next presenter, Richard Lyons, who's going to be presenting the paper, What Keeps Stablecoin Stable. And in the meantime, you can take some time and answer some of the chat questions. Like you can just type your answers into the chat. And so we can kind of move forward without being too delayed.
Great, thanks. And I'll go ahead and start here. We appreciate the opportunity, Ganesh and I. Thanks Alberto, thanks to all of you at Georgetown. Ganesh is at work, as you can see there. He's also on the call here, and so he may be able to help with things coming in on the chat. I'll be less tuned into the chat, and pardon me for that in advance. One thing I should mention in advance too, because as most of you know, there's actually a lot of litigation going on in this area. Ganesh and I have zero to do with any litigation. We're not serving as expert witnesses, nor are we engaged in any way. I think being super clear about objectivity in work like this is important, given how much, as most of you know, is on the table in this area. So what keeps stablecoins stable? The title and the main question. It's hard to answer that question without understanding what creates volatility in stablecoin prices. So we touch on that at the same time. But our central question is sort of how do their prices stay close to their pegs, their so-called pegs. A stablecoin could be, as most of you know, pegged to any store of value. Most all the ones that are of any size are pegged to a single fiat or national currency, the US dollar. Tether is the largest. Tether's the one, I mean, work with John and other people. Tether's the one that's had the most attention, and we'll see in a table, it's by far the largest with a roughly 85% market share, depending upon how you measure that. A surprise, at least for us, is that in fact, when you look at the trading of Bitcoin, Tether's on the other side of more trades than the US dollar. That flip started in 2019, so it plays a fundamental role in Bitcoin trading. Also, as a vehicle currency more generally, some of you know this, but we come from the world of foreign exchange more than anything else, and this is a fixed exchange rate, right? That's one way to frame what we're looking at here. And vehicle currencies, if you want to trade one emerging market's currency for another, very often you actually trade it for the dollar or the euro first, and then you trade the dollar or the euro for the second emerging market currency that you want. That's standard story of what a vehicle does. And in some ways, stablecoins are playing the same role here. Being on blockchains, they avoid a lot of intermediation costs. We all know that. One intermediation cost example that we've got written there, Bitfinex Exchange. It's, look, if you want to do a bank wire in dollars, there's just a bunch of stuff that has to happen. It can be 15 business days, 3 weeks or more for us to comply with anti-money and your customer type regulation. So anyways, that's an intermediation cost or a friction if you prefer the wider term. On this slide, most of you know that you could back. I mean, the question is, what's the collateral? Is it the dollar or another fiat or national currency? Is it cryptocurrency backed like DAI? We won't go too much into the details here, but there are stable coins that are backed by other cryptocurrencies, Ethereum in particular, for example. The table at the bottom gives a little bit of perspective. This is obviously just a quick overview of what's up. You can see that in terms of market cap, Tether is the largest. That's that USDT. Tether is, well, at the time, sort of April 2020, we're only a few months down the road. The Tether market cap now is about 9 billion, I think. So it's growing quite rapidly. The mean, standard deviation, min, max, those columns are all in basis points. So the idea is this is pegged 1 for 1 to the dollar. So I'll just focus on Tether. Our paper focuses more on that. But you can see what the mean, so there was a mean discount relative to the dollar, but quite a standard deviation, min and max over that period, roughly 3 years. And then the half-life, right? So what keeps stablecoin stable? The question of how quickly does it go back to 1, go back to the peg? That's a natural question, and that's the empirical half-life over these sample periods, the sample periods being the periods over which for each of these stable coins, we feel we have the best data. So in terms of questions and what we're going to look at here, how is the peg maintained? Kind of the how question. In the world of fixed exchange rates and exchange rate economics, it's the central bank that's on the other side, and the central bank intervenes in the currency markets and buys and sells and changes the supply of the currency. And that's the way we normally think about fixed exchange rates being maintained by central banks. Now, we don't have a central bank here. So the question is how similar is it? And in what sense is the Tether Treasury, to take a specific example, sort of doing something similar in terms of supply management to keep the peg close to 1? We've seen work by Amin and others about how quantity might be changing relative to other targets, but part of what we're focused on here is what keeps that trading price of Tether close to 1. And that's what we want to ask. What does that look like in a world without, strictly speaking, a central bank, and without anything like an arbitrage participant, if you're familiar with some of those mechanisms. Also, the two-sided distribution, just very quickly, coming from exchange rate economics, fixed exchange rates trade at a discount. They just do. I'm not saying a fixed exchange rate in the fiat world never trades at a premium, because there could be some probability of revaluation, of a jump up in value. But in general, what you get are discounts, and sometimes quite substantially. So it's a very, very skewed distribution in the fiat exchange rate economics empirical literature. And as we showed you before, we've got very much have a two-sided distribution. That was in that last table that I just showed you. So how do we understand or model where these premiums are coming from? It's the premium part that is a puzzle for an exchange rate economist. Maybe less so for you, but certainly with that lens, we want to understand what can drive that. So here's a very quick kind of correlational table. If we just ask the question, when that price is trading above 1, so these are pegged to the dollar at 1 to 1. So think of 1 as being the peg. When that price goes up above 1, when the delta there in that equation is positive, what's happening to supply? So you can see a positive correlation here. The idea being when the price is up, there is increased supply. There are flows from the Tether treasury, if you want to think about that like the central bank, into the marketplace, into the secondary market. So very loose, just correlational here. But if we wanted to ask ourselves, are we at least seeing a supply process that is consistent with the idea that supply increases when price goes up to drive the price back down toward 1, and vice versa? Do we see it in the data? This chart shows that we certainly do see it in the data. Real quickly, contributions of the paper, there's a lot of references, as there need to be in the paper, to the literature, and I've already mentioned John and Amin's paper, but there are many people that have written things that relate to this. Also in the exchange rate economics literature, which is an enormous literature, fixed exchange rates, how are they managed? How do you manage reserves and all the rest of it? So pardon me in so short a presentation, but we're gonna focus on just a couple of the things that hopefully people will be most interested in and remember. So why do we need a model here? You might say, well, I can kind of see how a premium could arise without needing a model, but we want to understand the channels through which premiums arise. When we went through the analytics, as we often hope, as analysts, we learn some things about, oh yeah, there's another channel, there's another way, or potential driver of premia. So anyways, we have a model that is in the paper. I'll talk very briefly about it in the next slide. And then, empirical, when we ask ourselves, so here's a fun empirical, we think it's fun, empirical thing. In our sample period, Tether went from the Omni blockchain to the Ethereum blockchain. And what that did effectively was increase very substantially, it kind of democratized access to the arbitrage function. So if you think there are these arbitrageurs that are constantly trying to sell when the price is above 1 and buy when the price is below 1, and then go back to the treasury and redeem at 1, right? That's an obvious arbitrage. The degree to which people could do that changed structurally. It happened in April of 2019. And so we're going to use that as a natural experiment to figure out whether this arbitrage process got enhanced. The efficiency of the arbitrage, or kind of the stabilizing forces, did they increase when Tether moved on to the Ethereum blockchain? It's a natural experiment. We have various controls. I'll talk about that in just a moment. So the model summary, I think that this is not a great use of our time because we're short on time, and we've got a third paper today, and I want to make sure we don't crowd out the third paper. But you could say, where do premiums come from? Well, we have lower intermediation costs using stablecoins in the model than using the US dollar, the fiat. But there's also a safe haven effect, which is kind of a risk premium effect. I won't really be able to explain it, but it's described there. There's a risk premium effect that can drive premiums. There's also a latency effect. I showed you that earlier example of the intermediation cost. If it takes me 3 weeks to get into and out of dollars from Bitcoin or some other crypto asset, then being able to do that quickly through a stablecoin becomes valuable not just because there's a lower cost to transact, but because there's a shorter time to transact. That's what we mean here. Data sources, again, I'll be quick here. Anybody who works in this area knows this stuff well. Omni Explorer and Etherscan give us the full history of Tether transactions. We need to construct flows from the treasury. And this does not just mean grants, because sometimes when the Tether treasury creates Tether through grants, it retains some of that Tether. So we want to ask, actually, if you thought about a central bank, how much of the new Tether is actually going into circulation, as opposed to how much is being created? Those are, in fact, two different questions. And Coin API helps us to think about, limit order book data, signed order flow. We do a lot of order flow analysis and impact, because we want to sort of test these arbitrage trades. Are they truly? I showed you a correlation. People. There tends to be an increase in supply when that price goes up above one, but we want to ask, what do these arbitrage trades actually look like? And that's part of the Coin API data. Super quickly on this accounting, I mentioned that the stock of Tether in circulation has really two components. I mentioned that we can see it on the slide there, that red component is the retained at the Tether treasury component. And when you're looking at the deltas, actually, if you just look at the correlation between the secondary market movements, the supply, if you will, in the secondary market, and the aggregate supply, what you would get if you just looked at grants, the aggregate supply, that correlation is about 0.5. So they are actually two very different objects. In any event, we want to do our best to measure actual supply in the markets, and this decomposition is important for doing that. This slide effectively says the same thing. That chart that's in the lower left-hand corner there is exactly the same chart, exactly the same data I showed you before, but this just gives you some sense for what we're measuring. We want that flow to the exchanges. We don't just want grants. Empirical tests, what are the sort of big questions we're looking at here? I mentioned that natural experiment, it's mentioned here. So with that Omni to Ethereum blockchain shift, did this increased investor access to the Tether treasury, that ability for sort of individual wallets or accounts or people to trade directly with the treasury rather than going through Bitfinex, which was sort of in the prior period what they had to do. Did the peg become more efficient in some sense? But what do we mean by efficiency? Did it reduce the volatility of price around the peg? Did it reduce half-lives? Did more and more people participate in arbitrage, as best we can tell? These sorts of questions. But we also want to use that natural experiment to sort of understand, all right, when you change access to an arbitrage mechanism, do you change the efficiency of that arbitrage force in stabilization? We also want to look at, very specifically, more quantitatively than either of the charts I just showed you. Does that flow from the Tether treasury into the exchanges have itself a stabilizing effect on the peg? And how do we quantify that? How do we measure that? That's another thing we look at. And then, a perfectly sensible, I call it an alternative hypothesis. One way to think about this is a little bit more robustness, because I think this idea that, in fact, movements in Tether supply are linked to Bitcoin pricing is a set of facts that Amin and John have established. And so this question of, when we look at aggregate supply at the exchanges, not just the sum of grants, but aggregate supply on exchanges, does that connect to or look like it's driving Bitcoin prices? So we're asking a very aggregate question there, whereas Amin and John we're looking at specific wallets, and so it's a different level of aggregation. But we still wanted to answer this question because many people understand the Tether supply process as being fundamentally linked to this question. So we felt it needed to be addressed in the paper. So why did Tether migrate from Omni to Ethereum? I'm not going to go through this slide. It did, but this is this quote unquote natural experiment that we're going to exploit. And then if you said, well, it's not really a completely exogenous natural experiment, I'll talk about some of the controls that we introduced to try and use that natural experiment in as robust a way as we possibly could. So how about this idea of when the structural change, so this is again that natural experiment, to the Ethereum blockchain, democratizing access to the arbitrage process whenever that stablecoin price departed from one, do we see an increase in specifically in individual accounts, individual investors these aren't necessarily individual, they're individual accounts that are trading with the Tether treasury directly. And we see a very big increase at the time of this blockchain shift toward Ethereum, which was April 2019. So this is qualitative evidence, but you see sort of the structural change in the degree to which arbitrageurs are directly, traders, I should say, but we'll look to see whether their trading looks like consistent with arbitrage trading in just a moment. So we divide the periods in this pre-period, this up until March 2019, and then the post-period, roughly a year following that, the post-period being on the Ethereum blockchain. So as a quick overview measure, does the half-life go down? It does go down in the post-period. The min, the max, the standard deviation, the mean, that post period looks like, wow, it looks like it's much tighter to the peg, and the data are fairly clear here. Now, if somebody wanted to say, yeah, but you're doing time series analysis, there are a lot of things that can reduce variance around a peg that could be connected with time series variation. I mean, you're trying to attribute this to the Ethereum blockchain, but we need to know more than just this table if we're going to say anything closer to causal. And so here's where we do this this idea of, well, okay, so if you took other stable coins, right, other stable coins that were already trading on the Ethereum blockchain, for example, True USD, True US dollar, they didn't change what blockchain they were trading on. They were trading on Ethereum the whole time. So the structural change is happening in Tether in April of 2019, but not in True USD or the other currencies. So we can look at that and say, well, we can control for sort of time series variation that might be producing the result in that table I just showed you by doing a difference in difference kind of an analysis, which is what this is. Very quickly, that dependent variable, we specify it two different ways. You can see that top line there is the dependent variable 1 is just the absolute value of the price change in the marketplace relative to the peg being 1 in all these cases. So we look at dispersion that way. We also look at standard deviation. And then columns 3 and 4 are the same two dependent variables, just with different regressors, obviously. And so we have a post dummy. We want to see what happens in the post period. That's kind of what we were looking at in that last table, if you will. But the question of post times t, so this is sort of Tether. Is there a bigger effect here? So in other words, is volatility going down even more for Tether than for in the post period than it is for other stable coins? That's the way to think about the question here. So that line that's post times t is a dummy that's asking us specifically for Tether in the post period, is there an even bigger effect, shrinking of the variance around the peg price? And we find it, and it's very strong. But that's sort of using this controlled experiment in the best way we knew how to do it. So timing is getting pretty tight here. I think I'll just present a little bit more, and then I think I'll cut to the chase. I can't see the chat here, but there may presumably some good questions there. Anything, by the way, we don't cover in our presentation, we will get back. We'll get the chat record from Alberto, and we'll get back to anybody who has any questions, of course. So here we're actually looking at the arbitrage flows. So with the limited order book and the signed order flows, right? So the buyer initiated trades less the seller initiated trades. And now we're trying to, we've got signed returns or signed changes in Tether prices. And we're relating those to the flows, in this case, from the treasury into the marketplace. So we want to ask, what is the price impact, as best we can tell? Not just are they correlated, but what's the price impact once we control for other things, lagged effects and so forth? The price impact of these changes in supply, these flows from the Tether treasury, that's this beta H, the flows from the Tether treasury into the exchanges. That's effective supply increasing when that's positive and decreasing when it's negative. And so when you look at sort of over what period are there price effects, whoops, jumped ahead, you can see that, again, this stands to reason, right? When the flow goes up, that's an increase in supply. So as you increase the supply of Tether, are you dropping the price back down toward 1? And we do see that. in the data. It's various sizes. Obviously, there's a magnitude to that. The beta H is pinning down the magnitude, but we're seeing statistically significant impact on the trading price that's coming from these flows. This is the last of the tests we looked at. Again, this isn't really testing arbitrage per se. This is more looking at the cross-market effect on Bitcoin. And we're asking not about individual wallets, which Amin and John showed, but the idea of the aggregate flow properly measured as the flow to the exchanges, not just grants, because again, those are two different animals, and sensible controls, which we can talk more about. Does this appear to have an impact on the Tether price? So when the supply of Tether goes up, are we seeing, price impact on measured this way using microstructure, high frequency analysis? Are we seeing impact on Bitcoin price? We don't find it in the full sample using the aggregate data as I described. I'm going to kind of stop on. I don't want to cut the next presenter here, but we also want to ask ourselves, look, if we're asking the question, what keeps stablecoins stable, we kind of also have to try and understand, well, what's driving them away from parity? Why does that price depart from one, above or below? And some people have looked at things along these lines. We wanted to look at them as well. We wanted to look at them in as naturally as disciplined a way as we could. And so we have various ways of testing in those order flow regressions and elsewhere, what are the things that are driving premiums? What are the things that are driving discounts in kind of structural order flow type equations? And we run a number of those equations naturally presented in the paper. I don't have a lot of time to present them here, but we do find that a number of the sorts of stories can be made even more in more disciplined ways. Like this cryptocurrency, so the safe haven, right? You could say, well, how do we define a safe haven? One of the things that we're looking at is, stablecoin returns and a cryptocurrency factor. If major cryptocurrencies are co-moving, do we want to think of that as a one way of measuring risk? And does that have an effect on stablecoin pricing in the sense that the stable, I'll leave it there. We go through that in the paper, but we're looking at sort of co-movements as metrics on those factors. So overview, look, there's some qualitative evidence of, are there correlations in the data between increases in supply of Tether and departures of that market price from the parity of 1-to-1? We see that obviously very qualitatively. When we go much more quantitatively and we ask, does it show up in the regressions? Does it show up in sort of the impact of central bank increases and reductions in supply? And then when we go on and ask the question using the natural experiment of the movement of Tether onto the Ethereum blockchain, which democratized access to that arbitrage process, right? What keeps stablecoins stable? Fundamental to that is private market arbitrage. And when you have a phase change in people's access to that arbitrage process, do we see big changes in the efficiency of that arbitrage? Again, efficiency measured as gaps or deviations between the market price and the peg. And we find very strong evidence that as you dial up the effectiveness of that arbitrage process, you see big effects on efficiency, even after controlling for time series effects, as we did with the natural experiment. So I'm going to stop there. I think we're right at 10 o'clock, and Ganesh is on the call. I can't see the chat. So if there are any questions, maybe if Alberto, if we could take one or two questions.
Yeah, I think so. I think, yeah, definitely. We have one question from Will. I'm going to ask him to unmute. And then we also have a question from Amin. We're going to try to keep it short, but we have plenty of time. Don't worry.
Okay.
Go
Thank
ahead,
you.
Will.
Thank you. Thanks, Rich. This is a really nice paper, really clean identification. I just have one question related to the fact that not all stable coins are created equal in a sense. Tether, while being very dominant, does rely on pegging or collateralization, whereas other stable coins such as Basis, right, Basecoin, they rely more on open market operation, base shares, base bonds, So in terms of the dependence on the supply channel, maybe the theory part in your paper would shed more light on that. The empirical part is kind of more on Tether per se, right, in that regard.
That's a fair point. It's a fair point. As you know, there are a lot of different collateral mechanisms, escrow accounts, and many other things. But some of them do have more explicit central bank type functioning in the background, whereas Tether Treasury says we are not a central bank. So you're right about that. The title says stablecoins, and maybe we've overgeneralized a bit. Point taken.
No, what I meant is the theory part might be more general. You have more to say about the supply side effect. Right?
I see. And so maybe leverage that for that. Good.
Yeah.
Thank you.
Thanks.
Yep.
And I think next question comes from Amin. Go ahead, Amin.
Right. Great paper. I feel a lot connected to the paper. It sounds very interesting to me. So just one comment, because the main identification of paper comes from this departure from OmniLayer to Ethereum, and then you call it democratization of access to Tether Treasury, basically. So one issue could be that OmniLayer is inherently very different from Ethereum blockchain or Bitcoin blockchain, where you have massive number of wallets. Each entity can have so many different wallets there. Like Bitfinex has several different wallets on Etherscan or Bitcoin. So, and it could be a bit difficult to capture all these identities. So it could partially be that maybe these wallets are somehow related to Tether that's trying to centrally basically control the peg. Maybe one way to address that would be to look at the number of exchanges, because at the end of the day, that's where people would exchange dollar for Tether. So if you look at the number of listing exchanges that have Tether to dollar pairs, if you see there's a jump there, maybe after democratization, that could be a better source of identification. So that would help, basically.
Great suggestion. Ganesh, I know you've looked a little bit at this. Thank you for that. I mean, I agree. Ganesh?
Yeah, thank you, Amin. Yeah, so I do agree that Ethereum layer has a lot more unnamed addresses. So we did dig into the number of unique addresses in the Ethereum blockchain. So we found in our sample period to April 2020, we found 172 unique addresses transacting with the Tether Treasury on Etherscan. And while we definitely can't claim to know the identity of all of these addresses, we found evidence that other exchanges are directly transacting with the Tether Treasury. For example, Binance has the largest recorded flow to the Tether Treasury on the Ethereum blockchain.
So one comment is that was the case on OmniLayer as well. A lot of other exchanges after 2018, like Binance had the highest transaction after 2018 with Bitfinex, just to have it. And maybe you can compare the volume and see if there's a jump there.
Yes, I mean, I think that the general idea of the structural change is, so obviously we are assuming that the increased number of unique addresses is corresponding to distinct investors. So that is an implicit assumption we are making. But another point to make is that the Ethereum blockchain does have a much larger number of addresses using Tether as a vehicle. And so if you just take that from a network effect, there's just a lot more investors using Tether on the Ethereum blockchain. And then naturally it follows that a bigger fraction of them would transact with the Treasury. But yes, so I mean, this is something that, you know, obviously in revisions to the paper, but we will try to document more this, the role of unique addresses transacting with the Treasury. So we will try to show that it is a much more democratic sort of access from the introduction of Ethereum blockchain.
Thanks, Ganesh, and thanks, Alberto. Thanks for comments.
Thank you so much.
Thank you.
Let's move to the third paper. Donghua Shin is going to present the paper Cryptocurrencies Pump and Dump Schemes with Tao Li and Baolian Wang. Donghua, the floor is yours. So
Yes.
take it away
Can you
whenever
see
you're
my
ready.
screen?
Perfectly, yes.
Yeah, okay. Thanks a lot for giving me a chance to present my paper. My name is Donghwa Shin. I'm an assistant professor of finance at UNC Kenan-Flagler Business School. Today, I'm going to present my paper, Cryptocurrency Pump and Dump Scheme, and this is joint work with Taoli and Baoli and Wang at the University of Florida. What is pump and dump? Pump and dump schemes are a form of price manipulation, and such scheme was common in microcap stocks, but has recently become more and more popular in the cryptocurrency market. In a pump and dump, investors artificially inflate an asset price and sell them expensively before the asset price crashes, as you can see in this figure. And why is pump and dump so interesting to academic researchers? It's because it's quite informative for studying manipulation theories. Allen and Gale, 1992, classified the manipulation into 3 different categories. In an information-based manipulation, manipulators not only buy and sell the securities, but they also spread out the false information. In an action-based manipulation, manipulators take some action, fundamental relevant action, other than just buying and sell the securities. But what's probably most interesting to academic researcher is the trade-based manipulation, in which manipulators just simply buy and sell the securities. And cryptocurrency pump and dump schemes are actually fall into this category. And it is also quite informative for studying financial bubble and investor behaviors. And it has very important policy implications, which is one of the most important part in this paper. Then why is cryptocurrency pump and dump so interesting? One of the reasons could be, as we may all agree, the blockchain technology is becoming more and more important. What's more important, the main reason, is that the cryptocurrency market provides an ideal laboratory to study pump and dumps. Why? First, identifying pump and dumps is much easier in the cryptocurrency market than in the stock market. In the cryptocurrency market, manipulators organize pump channels in Telegram and disclose this information, the pump and dump information, in real time. And what's interesting is it's very hard to catch the organizers because the Telegram is an encrypted messaging app. Therefore, the organizer can hide their real identities. In this pump and dump attempts, actually this information is revealed to the member, including me, free of charge. Therefore, it was very easy for us to collect the pump and dump attempts from Telegram. Second is because the effect of pump and dump is very immediate and large and lasts for only a few minutes, we can avoid the concerns that the effect is driven by other factors. For example, we don't have to worry about confounding false information or fundamental relevant actions. Therefore, the cryptocurrency pump and dumps provides a very, very clean setting to test trade-based manipulation theories. Let me explain how the pump is organized in Telegram using this example. This is the snapshot of the Telegram channel Big Pump Signal on July 4, 2018. The first message on this date was, dear member, the pump will be in 11 hours and 20 minutes. This means that, oh, we are going to pump something in 11 hours and 20 minutes, so you guys need to prepare for it. Next message is the pump is in 1 hour and 30 minutes. And in the next message, the organizers encourages the existing members to advertise this group to gather more and more new members, because having more members in the group makes the pumping much easier. The next message is important. It contains 2 important pieces of information. First information is 5 minutes, or we are going to pump in 5 minutes. The next important information is Binance, the trading venue where the pump and dump will take place. Next message, 2 minutes left, and eventually 3 seconds before the scheduled time, which is 3 p.m., the name of the identity of the targeted token is revealed, which is Nexus. And after the pump and dump, the organizers do some kind of performance evaluation. The pump went decent, not too good, and not too bad. And let's take a look at what actually happened to Nexus token at 3 p.m. on July 4, 2018. Here, the blue line plots the price movement around the announcement. And as you can see, here time 0 means the announcement time. As you can see, before the announcement of the identity of the token, we barely see the price movement. However, right after the announcement, we observe very fast increase in price, about like 50% of increase. And this increased price eventually converges to the original level. What about the trading volume? The red bar plots the trading volume, and as you can see, there is almost no trading volume, but right after the announcement, we observed a dramatic increase in trading volume. This is quite interesting and fascinating fact. And this fact actually led us to study this pump and dump more seriously using more comprehensive data. So we first identified the name of the pump groups in Reddit and Bitcoin Talk, which are two important information platforms in the cryptocurrency market. And after that, we collected pump and dump attempts of the group between May 15, 2017 and August 26, 2018 from Telegram. This is our sample period. Interestingly, in many pump and dumps, multiple groups actually work together. So we collect the pump and dumps targeting the same cryptocurrency at the same time in the same exchange. And we finally identified 500 unique pump and dumps, which involve 239 unique cryptocurrencies from 3 exchanges, Binance, Bittrex, and Yobit. By trading volume, they ranked first, 36, and 27th globally, and they are based in Asia, US, and Russia respectively. And we merged these pump and dump attempts with the trade level data of each exchange. This is high frequency data, and for each exchange for each trade we know price, trade size, and timestamp. This high frequency data is quite useful in documenting price and trading volume change around the pump and dumps, and is also quite useful in studying the reason why outsiders are willing to participate in the pump and dumps. We downloaded the trade data for Binance using their own API, and we obtained the trade data for Bittrex and Yobit from Kaiko, which is one of the most reputable data provider in the cryptocurrency market. First empirical finding in this research is pump and dumps are quite pervasive. We identified 210 groups, and from the active groups, we were able to identify 3,412 pump and dump attempts between in our sample period, which means on average, there were about 7.3 daily attempts, which is very, very large. Even more interesting thing is if you take a look at this figure, we observed that sometimes there were even more than 30 pump and dumps on a given day. So the pump and dumps are quite pervasive manipulated activities in cryptocurrency market. And let's take a look at the short-term effect of pump and dumps. I plot 3 figures for price, trading volume, and volatility. And the length of the window is 20 minutes. Starting from 10 minutes before the announcement and to the 10 minutes after the announcement. And here, blue line plus the average effect, and red line and orange line plus the 95% confidence interval. As you can see, the effect is immediate and large. In the first 70 seconds, we observe price on average increased by about 25%, trading volume increased about 128 times, and the 10-second absolute return, which proxies the volatility, increases up to 15%. And as you can see, the pattern is very, very clean. Due to its very clean pattern, it is hard to believe that the price and trading volume volatilities changes are driven by other factors. Another interesting thing that I want to point out is price run-up before the announcement. If you take a look at the first plot very carefully, you can see that the price actually starts to increase 5 minutes before the announcement. And how can we explain this? I think it could be explained by some members called VIP members who pay the fees to the organizers and receive the signal earlier than other usual outsiders. So in that case, they can buy the token in advance and sell it expensively when other participants participate, right? So this suggests some unfairness existing between the insiders and outsiders. What about the long-term effect? If we extend the window to 14 days, we can observe that eventually price, trading volume, and volatility converges to the original level. Here, we divide pump and dumps into 5 different groups, depending on the market capitalization of the targeted cryptocurrencies. And let's first take a look at the smallest cryptocurrency group. And as you can see, we observe qualitatively similar results. Price, trading volume, and volatility dramatically increase. But if you take a look at the price plot, the price actually increased a little more than the average, which is about 35% in this case, which is very easy to understand, probably because smaller token is more likely to or easier to pump. But what's very important is this. If we take a look at the largest cryptocurrency group, we still observe a similar pattern. Price dramatically increased, trading volume and volatility as well. This means that the main takeaway from these three figures is that even very large cryptocurrencies, by the way, the average market capitalization of the cryptocurrency in this group was $144 million, which is quite comparable to the median of CRSP firm size distribution. Even this large cryptocurrency can be pumped and its effect is big. So the pump and dumps are not restricted only to very, very small cryptocurrencies. But this is the big problem in the cryptocurrency market. And let's think about the arbitragers. If there is an arbitrager who observed that the Nexus token is being pumped at the Binance exchange, what can they do? Probably they can go to the other exchange to buy the Nexus token at the cheaper price and send it to Binance and sell it at high price to make money, right? So in this 3+, I documented the effect of this targeted token in other exchanges. As you can see, we observed some increase in price, trading volume and volatility. But if you take a look at them very, very carefully, you can observe that the numbers are much smaller than before. The price increase is just about 2 to 3%. And the confidence interval is quite wide, right? So the main takeaway is the spillover effect to other exchanges is quite weak. How can we explain this? This is possibly due to the inefficiency of the blockchain. Transactions in blockchains are very, very slow actually, and therefore the arbitrage trading across different exchanges is probably unrealistic. For example, in order for one transaction to be recorded in Bitcoin blockchain, we have to wait for about an hour. However, as you have seen, the bubble in the cryptocurrency pump and dump actually quickly bursts, right? So in many cases, this arbitrage trading is very unrealistic. However, in some cases, the price stays actually a little longer, more than an hour or so. In that case, maybe this arbitrage trading is profitable. That's why we observe some increase in price, trading volume and volatility, even though it's not very sizable. Here, I highlight the significant wealth transfer between insiders and outsiders. By insiders, I mean the people who already know the name of the token before the announcement. Therefore, insiders include pump organizers and the VIP members. Here, we measure the average return of the trading strategy depending on the purchase time and selling time. So if you take a look at the second column, before PNB, this column lists the returns that the investors who can buy the tokens between -10 minutes and 0 seconds. And if they immediately sell the token they purchased during this time period without delay after the announcement, they can generate about 13.9% of the return. If they hold it for 10 more seconds and start to sell, they can generate about 18% of the return. And as you can see, these numbers are quite big, quite large in all these columns. And the bold number means they are statistically significant. So insiders can generate a lot of money. What if you're an outsider who don't know the name of the token in advance? Then you have to wait until the name of the token is revealed and quickly buy it. Suppose you are quick enough, so you purchase the token after 10 seconds of the announcement. And depending on the delay time, you can still make some good amount of money. However, if the delay time is very long, about like longer than 90 seconds, then you cannot make money. What if you are even slower? Then you can barely make money. So this table, the main takeaway from this table is that only a very small fraction of the outsiders who are very, very fast in buying and selling can make money. And on average, outsiders lose money. So in the previous slide, I highlighted the unfairness existing between the insiders and outsiders. But here, I highlight the unfairness existing between different group of outsiders. Not all outsiders are the same. Let's take a look at the first panel, the last column, percentage of only. This percentage of only is the fraction of pump and dumps in which the announcement occurs before the scheduled time. So as we have seen in the example of Nexus pump, the actual announcement occurs 3 seconds before the scheduled time, which is 3 p.m. So we measure the fraction of this across each pump group, and as you can see, there's a big heterogeneity. As I said, in many cases, multiple groups actually work together. So it suggests that there could be some unfairness between the different group of outsiders. However, what's even worse is this unfairness is quite persistent. So if you take a look at the panel B, here we regress the delay time, which is the number of seconds that elapsed after a scheduled time, on the lag delay time, the delay time of the previous pump. As you can see, the coefficient is positive and statistically significant. If we replace this with the early dummy, which equals to 1, if the announcement occurs before the scheduled time, on the lagged early dummy, we still observe a similar phenomenon. This means that some groups persistently receive the signal later than the other groups. So some outsiders are even in worse situation than other outsiders. In the previous 2 slides, I highlighted the unfairness. Then our natural follow-up question is, why then do still outsiders still want to participate in this pump and dump? We find some suggestive evidence of overconfidence. But unfortunately, since we do not have the individual level trading data, we try to infer investors' learning by studying the popularity of pump and dumps organized by pump groups. So we do some pump group level regression. Here we propose several metrics to test this hypothesis. The first is early movers profit. This is the profit of the investors who buy all available targeted cryptocurrencies right after the announcement until the price hit the peak, and sell the all purchased cryptocurrency at the peak price. And only very, very fast early movers can do this. Similarly, we define early movers profit in the first 10, 20, 30 seconds. This is the profit of the investors who buy all cryptocurrency for the first 10, 20, and 30 seconds and sell them, assuming that they can take all the liquidity existing in the market. Another measure is insider profit, which can be understood as outsiders' loss. This is the profit of investors who buy all available targeted cryptocurrencies between -10 minutes and 0 seconds, and they start to sell them, assuming that they can take all the liquidity existing in the market. So here we use the abnormal trading volume during the first 30 minutes after the announcement as the measure of popularity of pump and dump. If you regress it on the recent insider profit or some average performance measure of the outsiders, we barely see any statistical significance. However, we see statistical significance in 2 columns, column 4 and 5. The related dependent variable is recent early movers profit and recent early movers profit in the first 10 seconds. And this statistical significance disappears if we increase the length from 10 to 20 and also 30. How can we explain, how can we understand this phenomenon? Seems like outsiders' participation is not very sensitive to their average past performance, but sensitive to the performance of very, very fast early movers. However, we all know that it is very hard to achieve early movers profit. You need to be extremely fast. So it could be the case that the average outsider could be overconfident, which means they could think that they can move faster than the others. So this is some suggested evidence of overconfidence to explain the participation of pump and dump by outsiders. Of course, there could be some other potential mechanisms such as gambling preference or entertainment. And the natural follow-up question is then, what is the economic consequence of the pump and dumps? In order to answer to this important question, we take advantage of a natural experiment. On November 24th, 2017, Bittrex, one of the US-based exchange, banned pump and dump. How did they do that? Bittrex froze the account of the individual who participated in the pump and dumps. And this simple policy was actually quite effective in reducing the number of pump and dumps, as you can see in this figure. The blue bar plots the frequency of pump and dump in Bittrex. As you can see, time 0 here means November 24, 2017. Before the ban, there were a lot of pump and dump activities in Bittrex, but after this ban, we barely observed pump and dump activity. So it was quite effective. We used diff and diff approach to quantify the effect of economic consequences of pump and dump. Here, we define the treatment group as the cryptocurrency listed on Bittrex. But remember that this cryptocurrency actually includes the cryptocurrencies that are listed not only in Bittrex, but also in other exchanges. So as long as they are listed on Bittrex, they are included in this treatment group. In order to find the reasonable control group, we use propensity score matching using the 5 variable: past market capitalization, past trading volume, cryptocurrency age, past 5-day return, and a dummy indicating whether a cryptocurrency is a token or a coin. We eventually identified 193 treated and control pairs, and we do some basic diff and diff regression. Here, DV, dependent variable, is either log normalized volume or log normalized price. Here, volume, log normalized volume is log of volume IT. Here, I denotes the cryptocurrency divided by average trading volume in the past. And log normalized price is log of price IT divided by the price of this token in the past. What's important here is volume IT is aggregate trading volume, and price IT is also average price across all exchanges, because a token or cryptocurrency can be listed in multiple exchanges. The result is quite clean and sizable. If you take a look at the coefficient for the interaction terms, they are all positive, statistically significant, and economically significant. For example, if you take a look at the second column, we use 15 days window, starting from -7 day to +7 day. You can observe that volumes of cryptocurrency listed on Bittrex increased by 21.2% more between this time period. And if we increase the length of the window, the effect becomes even bigger. It's 26.4%, and it becomes even more statistically significant. We observed a similar pattern in price. If we use 5 days window, we observe that the price of cryptocurrencies listed on Bittrex increased by about 4.1% more. And this magnitude becomes bigger if we increase the size of the window, length of the window. And we observe some parallel trend. But one could say that the cryptocurrencies listed on Bittrex could be inherently different from the matched cryptocurrencies. This is a fair point. So in order to address this concern, we hypothesize that if this Bittrex ban made investors more willing to trade cryptocurrency on Bittrex, for a given cryptocurrency I, cross-listed on Bittrex and other exchanges, its Bittrex trading volume will increase more than its volume on other exchanges. So we are now fix the cryptocurrency and compare the cryptocurrencies that are listed on Bittrex and others. However, due to arbitrage trading, we do not expect that for cross-listed cryptocurrency, its Bittrex price will increase more than its price on other exchanges. So here we focused on the cryptocurrency that are cross-listed. Idea is simple. Previously, we used volume IT, but now we decompose it into 2 parts: volume I Bittrex T and volume I non-Bittrex T. And we do the similar thing for price. And we run this regression, diff and diff. Here we expect that the coefficient for the interaction term beta 3 should be positive only in volume regression and insignificant for in price regression. And that's what we observed. And this research mitigates the concern because now we only compare the same cryptocurrency. Please take a look. Please note that we here used cryptocurrency fixed effect. We compare the same cryptocurrency, and any difference has to come from the difference of Bittrex and non-Bittrex exchanges. And this very, very convincing diff and diff result provides very important policy implication. First, should cryptocurrency be considered illegal? Maybe yes. Kyle and Viswanath proposed 2 necessary conditions to classify a scheme as illegal price manipulation. The first condition is the scheme makes price less accurate as signals for efficient resource allocation. Second, it makes the market less liquid. Our results for price and trading volume suggest that the cryptocurrency pump and dump satisfy both conditions, and it seems that it should be considered illegal based on Kyle and Viswanath's suggestions. Another implication is it beneficial to regulate and ban cryptocurrency pump and dumps? The answer to the question is definitely yes. Our results provide causal evidence that pump and dumps are detrimental to liquidity and the value of cryptocurrencies. And what's very important here is Bittrex ban example shows that the banning pump and dump is quite realistic. So let me conclude. Pump and dumps are quite prevalent in the cryptocurrency market, and we observed immediate and large effect on price, trading volume, and volatility. It was puzzling to understand why outsiders participate in pump and dumps, and we provide some suggested evidence of overconfidence to answer this question, and we find some strong evidence that pump and dumps are detrimental to liquidity and value of cryptocurrencies. Thank you.
Thank you very much. Dongguo, it was an awesome presentation. I just have a couple of quick questions. I know we are out of time, but I think this can be addressed kind of quickly. So we have the first question come from Zun Liu, who's saying,
how can I see the chat window? Can I see?
Oh,
no?
I can read it to you, but I think if you stop sharing, you'll be able to see it. Stop
okay,
sharing the screen.
Okay, let me stop share. Okay.
And then you can see the chat.
Okay, yes. So
he's asking, do you check derivatives returns on the pump and dump cryptos?
No, we didn't. But how is it related to our paper? Derivative written on the cryptocurrency?
I think it's just mainly kind of, I think it's probably related or is thinking about arbitrage.
I see. I think recently there are some cryptocurrency derivative, but most of the derivatives are written on main cryptocurrency like Bitcoin and Ethereum or something like that. But most of targeted cryptocurrency here is some somewhat less well-known cryptocurrencies. So Bitcoin or Ethereum are not the targets of the cryptocurrency pump and dump.
I see. And so, okay, then I think we have another number of questions that came in quickly. So you can take your pick. Maybe pick one of them you want to address. I think we are out of time. So I think it maybe makes sense for you to just choose one that you think it's interesting for you to answer. And then we can...
So Alexander Tick asked, what do you think about the current regulatory aspect? Why is this market still go unregulated? And what would you recommend to do stop pump and dumps? I think there are many challenges because in order to regulate this pump and dump, cryptocurrency pump and dumps, in SEC's perspective, they have to be convinced that cryptocurrencies are securities. But there are still ongoing debate whether cryptocurrencies should be considered as securities or not. And another problem is there are many trading platforms around the world. So we need some, I think we need some global coordination to stop pump and dumps. And there are many questions.
Yeah, no, exactly. I've saved the chats, so I will send the chat messages to all the co-authors and presenters, so you guys can look through it and you can contact directly the people if you think
sure.
The questions. Yeah, that sounds great. So I think, given that we are 5 minutes late, let me just thank all the co-authors of the paper and the presenters, Min, Rich, and Dongguo, for a fantastic job. Let me also thank the audience. So you guys have been incredibly active. So many questions are coming in through the chat, and it's so nice to see so much interest. So we have always new initiatives at the center. So please make sure to check our website and follow us on Twitter at GUFinPolicy. And we will not host an event next week because of the 4th of July holiday. So we will resume again on July 10th, and we're going to have another day like this, but we're going to focus on machine learning. So it's going to be Machine Learning Day, and you'll receive detailed information over the next couple of days. But thank you so much for logging in. It was great to have you, and thank you so much for the presenters again.
Thanks a lot.